Ben Graham is known as the father of value investing. He said, in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. What did he mean exactly?
Well, the stock market in many ways is a fashion market. Whatever is in fashion at the present moment is going to do pretty well in the stock market. On the other hand, the long-term earnings growth and sales growth of a company is key to valuation over the long term. So things can become fashionable in the short term, but if they don't perform in the long run in terms of their earnings and their sales, they're not going to measure up. So just be aware. Oftentimes, the smart investor will use the short-run issues, the fashionable nature of the stock market, to time buying, whereas whether to buy or not to buy is a long-term proposition based on analysis of the outlook. So that's kind of what my interpretation of Ben Graham's point was.
Right. So over the long term, stock prices follow corporate earnings.
That's correct. Yeah.
All right. All right. Well, what about investing outside of the U.S.? Should individuals have exposure to foreign stocks?
Yeah, I think they should. We've been very low. We've had very low exposure to the international companies, but that was unique to us. But I think in general, international companies deserve a place in everybody's portfolio. There are 2 or 3 reasons for this. Number one, the issue is value right now. International stocks, like value stocks, for instance, have underperformed fairly dramatically. We can see that the blue line here, which represents international stocks, and the red line represents the U.S. stock market. And you can see over the last 5 or 6 years the dramatic difference in performance of these 2 categories. So there's good value right now in international markets. The second reason that I think makes some sense is diversification. There is a high correlation between U.S. and international stocks, but it's not a perfect correlation. And as a consequence, when you get a decline in the stock market, you're not going to experience it perfectly in both the U.S. as well as international markets. So it makes sense to diversify your portfolio with some international exposure to cut down on that volatility in bad markets. So I think this is a very important reason to have a position in the international markets.
Okay, so the prior chart compared the performance of the U.S. stock market with what's called the EFA, which represents developed markets around the world, primarily Europe and Japan. What about emerging markets like China, Brazil, other countries in Central, South America, and Asia?
I think they should play a role in everybody's portfolio. Now, I wouldn't tell you, because they're higher risk than developed markets, I wouldn't tell you to have a large percentage weighting in emerging markets, but I definitely have a piece of my portfolio devoted toward those. We have a small piece in emerging markets in our portfolios as well. Now, let me say this about weighting. We have about a 20 to 25% weighting in our equity portfolio in international, and a piece of that 20 to 25% is emerging markets. That weighting is probably low by comparison with other professionally managed portfolios, which would usually have somewhere in the 30 to 35% zone. But it reflects our opinion of the fundamental outlook on international securities, and the U.S. is still the engine of growth for the world right now. So that's the reason we're so heavily weighted in U.S. versus international.
Well, speaking of emerging markets, China is the second largest economy in the world. What's your outlook for China specifically?
Well, I think if you're able to look 20 or 30 years down the road, there's no question in my mind that China is going to be a very, very important factor, probably the leading economy around the world. and probably growing very fast, much faster than our economy because they're so young. But the problem with China is it's a communist country. You can't get solid numbers, so you don't really know what kind of growth you're going to experience. And they are experiencing a pretty sharp slowdown in their growth rate. So the problem there is we don't have strong visibility or transparency in the short run. But in the long term, I think China is a very, very attractive market.
All right, Bob, let's migrate now from stocks to fixed income securities. What about investing in bank savings accounts and CDs or in what many consider super safe U.S. Treasury bonds?
Well, that's a challenging area, no doubt about it. I mean, we've been on a zero interest rate policy now for almost a decade. As a consequence, the fixed income markets or the bank markets, for instance, savings accounts and CDs have been generating very little, if any, return whatsoever. As far as the bond market goes, we have a healthy position in bonds, but we're very diversified. The reason the bond market is challenging is because of the fact that interest rates are very low right now, historically low, and likely to begin rising sometime in the future. Now, we haven't been correct in forecasting that increase yet. Nobody has. So I can't tell you when interest rates will start increasing, but they will. And at that point, you then are exposed, if you own Treasury bonds or pretty much any long-term bond, you're going to be exposed to principal risk. And what I mean by that is when interest rates rise and you're holding a bond, an older bond, with a lower interest rate, you will have to mark down your bond in terms of its price if you're interested in selling it. Hence, you have principal risk there, and that's generated by interest rate risk. So in the bond market, you will always have that if rates are rising, and it will get greater the longer the duration of that bond, or the longer the maturity structure of that bond.
But still, we do have some exposure in our client portfolios to Treasury bonds and other fixed income securities. Yeah,
but there are ways to minimize that risk, and what we've done is we've diversified the portfolio. We hold some floating rate securities in our portfolio. Those will often carry more credit risk because they're bank loans to lower credit grade companies. Usually these are young companies that have to work with banks. They don't work with public markets. So there is greater credit risk there. But there's no interest rate risk because the interest rate is renegotiated every 30 or 60 or 90 days. But that gives you the insulation to a rising rate market. The other thing we have done to diversify our portfolios is we buy some sovereign bonds from overseas, generally from economies that are developed and pretty safe. For instance, Norwegian bonds produce somewhere in the neighborhood of 1 to 2 percentage points more than U.S. government bonds, and yet it's a AAA rated credit. So those are very attractive. The Canadian bonds sometimes are attractive. They were hurt last year because of currency issues, and you have to watch out for that. So if you can get dollar-denominated bonds, that eliminates that risk. But the point is to get diversified, and we've done that by using different sectors of the bond market. I mentioned the sovereign debt. The other thing that we have done, and the floating rate debt, the other thing we have done is we've bought some mortgage-backed securities, and I think that's an attractive market. That's held in another fund that we use, the Loomis Sales Bond Fund. So I think diversification can help you do well in the bond market despite the fact that interest rates are very low right now.
Okay.